Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to DealCatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at DealCatalyst. Joining me today are Todd Trabaco, head of private debt advisory for StepStone Private Debt, and Nino Nicotra, director, private capital markets at Kroll. Nino, Todd, thank you very much for joining me. Looking forward to our conversation.
Thanks for having us.
Thank you, Todd.
Of course. So before we dive into, obviously the partnership and a little bit more about why we're here, for those who might not know either StepStone or Kroll, maybe just take a quick 30 seconds. Who is StepStone? Who is Kroll? And a little bit about yourselves. And Todd, I'll start with you.
Sure. So StepStone is an alternative asset advisory and third-party manager. Total capital under responsibility is about $800 billion. In the private credit space, it's about $80 billion. We deploy in private credit about $12 billion annually, and that makes us, we think, one of the largest private credit allocators globally. I work with the advisory team, so our job is to provide consulting services to institutional investors. In this country, that's primarily public pension plans, but globally it includes insurers, banks, wealth management platforms, and sovereign wealth funds.
And Nino?
Yeah, thanks. Kroll is the leading independent provider of financial and risk advisory solutions. We have over 6,500 professionals worldwide, nearly a century of trusted expertise in risk, governance, transaction, and valuations. I sit in the private capital markets team here at Kroll, which is part of our private asset valuation solutions group. In our group, we've created an ecosystem that combines technology, independent expertise, and proprietary benchmarks that we're going to talk about today. So pretty excited. Thanks.
So thank you both. As you just alluded to there, so what is the Kroll StepStone Private Credit Benchmark?
I'll take this. So the Kroll StepStone Private Credit Benchmark is what we call a loan level benchmark. It's a benchmark that goes from bottom up. And what we do is we give an insight into the market. So we've partnered with StepStone. We launched this benchmark in September, and it is a combined data set which comes through our valuation practice. Right? We value probably 1,000 loans a quarter, and then StepStone, through their advisory business as well as their co-invest business, we see a lot of loan level data, and we've aggregated that data, anonymized that data to provide a look into the market. And the data set's pretty large, right? So it's over 14,000 obligors, over 16,000 deals. And if you're looking at all the different loans, we have about, in tranches, it's over 25,000 loans.
So what was the problem that you were trying to solve, and why hadn't something like this already existed in the marketplace?
I can take a shot at that. So the problem I think that the benchmarks solve is that of transparency and relative performance. So when you think about private markets compared to any private markets compared to public markets, the amount of transparency looms largest when it comes to investor appetite. If you want to know what a stock is trading at, its price, you can just dial it up on the internet right now, right? You used to need Bloomberg. Now anybody can figure it out. Can't do that with private equity. You have to wait until your marks come in. You're not really sure. You only know what your portfolio is doing. In credit, if you want to know where a bond's trading, depending on the bond, if it's treasuries, you can go on the internet. But if it's high yield or something else, then you've got to go to Bloomberg or Trace or something. And the same thing with private credit, right? The window that investors had into private credit was limited to the GP or the fund manager in which they were invested. That was their sole source of data. Whatever they were given by the fund managers or the GPs was all that they saw. And that's great if you have 10 different managers, but if you have one or two, it's not nearly so constructive. What the benchmarks do is they aggregate data from hundreds of GPs. It essentially gives you a view into the market and allows you to see at the loan level what's taking place in direct lending in private credit. So now, if you're invested with a fund manager or GP, you can look at that portfolio and see what that performance is, but your visibility is no longer limited to the 100 or 300 loans in that portfolio. You now have access to over 20,000 loans. That's important because now you can make a much more, as an investor, you can make a much more informed opinion as to the performance of your manager. Nino, what did I miss over there?
No, that's true. It's not just for the LP though. The GPs, this information is valuable to them as well. Obviously, the larger GPs have access to more deals, so they see more of what's coming to market. But for a smaller shop, data like this, right, timely data, and I didn't mention this earlier, but our data set updates on a weekly basis. This timely data is important and allows them to use it in their negotiation of new deals, right? Better understanding what other deals are pricing at. But
And
yeah,
can I tackle the other side of that coin too, guys?
Yep.
So GPs all say that they're the best and that they're better than the market, they're better than everyone else. Now they can actually prove it. Now they can actually say to an investor, you should put your money with me. Look at the spreads I'm capturing. Look at my pick rate. Look at my leverage points, my LTVs, my interest coverage, and look at what the Kroll StepStone benchmarks say. I'm doing better than the market. And that obviously, they can say that with much greater confidence now. They probably already knew it in their bones, but now they can actually point to empirical data that supports their claims. Obviously, the flip side of that coin is not everyone who makes those claims can back them up. But that's a different matter altogether. So I agree. It definitely helps GPs too.
I presume that, especially at a time like today, where private credit's in the news for all sorts of reasons today, that something like this becomes even more important, that they can make decisions on a faster and more efficiently than maybe they have in the past.
Nino, you want to take that, and I can talk
yeah,
about the
100%, right? Not only do they have data at their disposal, but it's a larger sample size, right? When you talk to funds, and like I mentioned earlier, their sample sizes are smaller, right? And when you read or listen to what's happening in the news, they take that small sample size and they go in and amplify what they're hearing. And sometimes that's not reflective of what we see in the data.
Yeah, I can give you two examples of how our benchmarks have been used lately to really shed some additional light. So one thing that the benchmarks will show is what many people suspect and what the broadside press has highlighted, that spreads between upper middle market direct lending, core middle market direct lending, and lower middle market direct lending are very tight, right? And that's an empirical observable fact. But that's not the end of the story anymore. It used to be, because that's what's published by other data providers. Now a user can look at our benchmarks and say, yes, that's true. But if you look at the important risk side of that equation, leverage points actually are lower in the core and lower middle market. Interest coverage ratios are actually higher in the core and lower middle market. So an investor can say, okay, sure, pricing similar, but is risk the same? Now, there are obviously other components that go into risk. Those are not the only two that people should look at, but it certainly enriches the conversation, the analysis. The other example I'll give you is this. I talk to occasionally investors across the spectrum, from institutions even to some RIAs, and the question about what's really going on in private credit, I show them one graph, and it shows, because we track not just loan level data, but borrower level data too. And you can see the steady EBITDA margins across all of those borrowers going back to whatever time frame you want. And that is an underlying indicator of strong financial health when you don't see EBITDA margins. Now, there could be greater dispersion. That's a different story. But the idea that there's a wholesale meltdown at the credit level, I think that if you look at our benchmarks, you'll see that that's probably not the case.
In terms of, you both obviously have referenced, GPs. I mean, how are they embracing or resisting the increased scrutiny on some of their portfolios?
They're looking for data, right? They're looking for data points to help them with their message and what they've known and seen. And this helps them to a certain degree, right, when they're communicating to their LPs. So our business here at Kroll, a lot of times we've always spoken with valuation teams, right, and helping them with their marks. But now, with the benchmarks, the interest isn't just coming from the valuation teams to understand how the market's moving. It's coming from the origination teams, right? Help them better price some of these deals or just confirm what they see. Investor relations is a strong peer or person that we're dealing with now, because they need to communicate this to the internal investment committee as well as their investors. So they like the data. They have not. No one in the GP community has been taken aback that we're publishing this type of data or feel that it's a threat.
So we've been holding several different events nationwide. And I will tell you, Todd, Nino, back me up on this. I will tell you, Todd, that the most eager participants and often the most numerous participants at these events are the GPs themselves.
Yep.
I mean, I would say, the private credit, as always, a portion of it has, the premium in private and illiquidity. And if increased transparency comes to private markets, are you going to lose some of that premium because they look more like public markets?
And I hope not. I don't see increased transparency as anything other than a good thing. I think there are structural limitations that I just posted on LinkedIn on this, actually. I think there's structural limitations to a convergence of public and private credit across the board. I think there are things that will present that. We can dive into greater detail, but I think that's for another podcast.
Yeah, and there's no active secondary market, right? So when you're talking about public markets, one of the benefits or one of the features of that market is that you can get out of something right away. And part of the news stories that we're hearing in these redemptions is the fact that these vehicles were not set up to function in that way, right? And so that difference, I don't see how that's going to change right quickly in terms of that convergence of the two markets, but that's my opinion.
So if we, kind of go back a bit in terms of the market itself, beyond obviously the benchmark partnership, I mean, where would you say we sit in private credit today? I mean, obviously there's a lot of noise with what's been going on in the market, but structurally, from what you're saying here, I've talked to others as well, it feels like the market is structurally sound. But from your perspectives, kind of where would you say we are in the private credit space?
Look, I think we're going through growing pains. Nothing goes up and to the right consistently all the time. I believe that a lot of the activity that we see in the retail space is driven by a level of irrationality and panic. I firmly believe that, and that's not to cast aspersions on anyone who disagrees or is trying to redeem. It's just my opinion. I don't think that the fundamentals warrant the type of hurting behavior that we're seeing now. I will tell you that on the institutional side, and I spend the vast majority of my time talking to institutions, there is no concern about direct lending or private credit generally with respect to asset quality. There are other concerns, maybe spreads, maybe other, but no one's concerned about a meltdown, and no one is certainly, that I've spoken to, reducing their allocations to private credit. In fact, they're increasing their allocations to private credit. Some are actually increasing to direct lending after having mature portfolios. They want to add more. Others are diversifying away from direct lending into other strategies and doing other more opportunistic things. So, what I hear from the institutional clients that we have is is almost the exact opposite of what you read in the press.
And I mean, it's part of it, and this goes obviously back to your benchmark in terms of the education gap. Obviously, part of it could be back to an education gap with the retail investor, but products like this help to bring more awareness to what the structurally sound level of the market is, even if there's fear through some of the articles and news shows. I presume that's what products like this help do, is just bring more awareness to the market overall.
100%.
Yes.
They help you tell the story. They help people understand what the market is or where it's at and different components of the market, right? Because it's difficult in an opaque world, right? There are certain data points that you can get from publicly traded BDCs through their filings. However, it's not a rich data set. It's not a timely data set. And so what we're providing gives people a look into a market that they read about, right? And they could actually put data behind it, right?
So here's a real use case scenario, right? Imagine that you are a investment director at a pension plan, and you start getting questions from the deputy CIO or the CIO about the private credit book. You can look at your portfolios with your direct lending managers, and you can immediately comp them to the market. And hopefully there's good news, but there's some sort of backup when you go to your higher ups and say, no, our portfolio is actually faring quite well. Here's why. According to the Kroll StepStone Benchmark, pick rate is X. The pick rate in our portfolio is 1/3 X, right? Empirical data. The level of non-accruals, the level of defaults, loans trading below 90 in the Kroll benchmark are X. Ours are a fraction of X. You can have a much more informed dialogue with your investment teams when you have that type of data. And you don't have to go looking for it. You don't have to do a Google search for this index or for that benchmark or for whatever. It's all in one place. You can dial it up. You can go into your boss's office. You can call, you can send them the link, even hopefully they subscribe to. Another use case is if you're a wealth manager and you've got exposure in some vehicles, you can use this to show relative performance and value, or to make a decision to say, perhaps this GP is underperforming the benchmark. I can rotate out to another fund manager. So the use cases are really endless, and they'll just help, improve the dialogue and help people make better decisions, which is all we really want, right?
Do you think a better data infrastructure in the long run, as your benchmark continues to evolve and continues to go through iteration 4 or 5, whatever iteration it might be on, does it help accelerate that democratization of private credit in the long term, even if it's going through a bit of a lull now with the retail investor?
Listen, I look at it a little bit differently because I'm in the institutional world. Listen, I started lending money in 1995. I've been a consultant on and off since 2016. This is the single coolest innovation that I've seen in the private credit markets, full stop, since then. I equated it on another podcast to the invention of the forward pass in football. I think it's really, really important. And here's why it's important, right? Let's talk about the institutional world. Okay. If you're an investment director managing a private credit portfolio and you've got a much, much larger allocation within your plan to fixed income, and your private credit or your CIO comes to you and says, what do you think the average rating is? What do you think? How are we doing relative to fixed income markets? If you can comp your book using our benchmark to a fixed income allocation at a public plan, that transparency helps. It helps the CIO make better decisions, or the deputy CIO. And if private credit actually is and has the value proposition that I certainly believe it does, I've committed my career to it, then that can only help allocations grow. That can only be good for the asset class in that regard.
Just so I'm clear, everyone's clear. If we were to go back 5 years, other than say maybe some of the top pension plans who probably allocated to dozens or X amount of managers, this type of data was limited to a handful of pension plans across their managers, and everyone else was essentially in the dark. And this is shining light to that darkness that used to exist.
I think so. I remember I was at a competing consultant, and I tried to do something similar to try to get a view into what was going on in the private credit market, and it took me 2 months to collect the data, and I had to send out hundreds of emails. To have this with a wonderful UI user interface, to be able to just click and choose and segment the market with ease, it's just, I love it. I'm jealous that Nino gets to talk about it every day.
It is unique, right? It's not just a data point on a PDF. What we've done is we've put it into software. So the group of us that came over to build it, we came from Bloomberg prior to here, so we have a little bit of experience in this type of software, and we're excited. When we came over here, not just private credit but equity as well, a lot of what was being done was on spreadsheets, right? You talk about the
Right.
infrastructure, it's very fragmented. Um, Slow to a certain degree, but we've created this software or this solution, obviously, so that we can produce the benchmarks, but also from a workflow perspective, our valuation practitioners use our software to run valuations on private credit, and that software we're now making available to clients to use to kind of replace their Excel for internal valuations, and it's been a game changer. Some of the feedback we get even on that, and I know that's not today's subject, but on the ability to use the software so that they can scale, so that they can have conversations at a higher level. It's been really rewarding to see that.
Obviously, as this continues to succeed, competition comes into the space. Is there a fear that, there's the potential for other benchmarks, and then it's, does this benchmark carry this, or and does it end up making the market confusing over time as you see success with this? Because obviously success will breed, those that want to copy it or try to do their own. And so how do you think about, kind of that dynamic potentially playing out in the future?
We are we are one of the largest data sets today. No one knows the exact number in terms of size of the private credit market, right? There are numbers of 2 trillion out there that we read
Yeah.
about in the papers and such. If you look at the outstanding that we have on the platform, it's 1 trillion. Would you say it's 50%? Maybe, I guess you could based off of that number, right? In terms of the data set. So it is one of the larger. If a competitor does come, the question is, okay, well, what's that percentage of the data set, right? And is it data that's coming to you directly, right? Do you validate the data points, or is it something that you're scraping from public filings and a delayed data set, right? Something that doesn't have as much granularity as what we're providing.
If we look a bit into the future, what does this benchmark look like in the next few years? Just bigger and
So
better?
yeah, I know. So one of the things we've been talking about this for 5, 6 months now, and we always get a lot of feedback. People are always looking for additional data points and additional tools. One of the things that we're working on that has been highly requested is the ability to provide origination teams a way of uploading their target loans and being able to create a comp set using some of this data, right? So that they can better price some of the new deals that they get into. So tools like that, right? Solutions like that that help the market is sort of what we're seeing the future of this benchmark go towards.
And we're also going to be introducing more kind of detailed measures of, I think, pick rates and defaults and stuff like that. Like, right? right now we have some proxies, got great data, but we're going to go deeper and be more specific. And that's going to be extremely helpful. If I had that now, I would just post that on LinkedIn and drop the mic.
What's the biggest, unlock that has yet to happen in the private credit space?
Oh, wow. Was that on the question list you sent ahead of time?
It was.
Look, I think you're talking to the wrong guy, right? I mean, I'm a big believer in private credit. I ran underwriting at a private credit shop through the GFC. So I think it's a very resilient asset class, and I think it's a tremendous generator of income for people. Whether you're getting it through a pension plan because you're a cop or a firefighter, you're getting that income. Whether you're an individual that's putting money in a private, yeah, I think that it's a wonderful generator of income. So I think, you know, with respect to an unlock, I don't know. I just think it's such a useful allocation that my hope is that the allocations will grow across the board. And I hope that the best managers are rewarded and keep doing what they're doing.
And I would say education, right? Private credit is being talked about a lot in the news with limited education out there. So to the extent that this educates some of those investors that are kind of in between that retail and private wealth, and those that are now getting access to private credit, now they could better understand what's going on, right? Rather than having to read about it in the news.
Can I change my answer?
Sure.
Yeah, what Nino said.
I mean, one final question before we get to a couple of fun questions before we wrap up. The terminology in private credit, because obviously today the term private credit means more than it did 10 years ago. And so does it need a terminology refresh? Because, I talk to people today, and private credit is anything from direct lending through to ABF through to fund finance. But, many in the market view private credit as the traditional direct lending. Do you still view it through that lens? Or does it need a little refresh of, hey, we're talking just direct lending versus private credit?
The benchmark is that, right? It's corporate direct lending.
Yep.
But you're right. When we talk to certain folks, they are talking about ABS and some other products, and um, those guys are also interested to see how it compares, right, to what they're
Of
seeing
course.
in those markets. But yes, it is corporate direct lending, what goes into this benchmark.
So we have just a couple of minutes left. So I like to end the episodes with a little more fun. Um, First to you, Todd, favorite sports team and or hobby?
Oh, favorite sports teams, the Philadelphia Eagles, man. Come on. Go Birds.
What about you, Nino?
Thankfully, I'm a Mets fan. However, they won yesterday, and I'm feeling good about this season like I do every spring.
I was there, so I'm a Mets fan as well. So
Go Mets. Go Mets.
go Mets. Nino, I'll do the next one. This one to you first. One
Yep.
surprising thing about yourself.
I'll tell you guys something interesting that happened to me in college. So I was working for a company, a telephone company, and they made a mistake on my paycheck, and they paid me $2.8 million by accident. Yep.
Wow.
So I received the check. It was 1.3 after taxes, so the government took 1.5. And I remember going to the bank because this was a Friday. So on Saturday, I went to the bank and I said, "All right, let me transfer from my checking account to my savings account. Maybe I'll pick up a little bit of interest on it." And the teller said, "The girl in the back wants to know if you're married." So I had to return that money. They took it quickly, but it was a fun story.
It's definitely one to hold on to in terms of a story. What about you, Todd? Something surprising thing about yourself?
Um, I think one thing that not a lot of people know about me, here's one. I was recruited to the Central Intelligence Agency 3 times in my life.
Wow, that's pretty cool.
You weren't taking no for an answer?
True story. That is true.
Wow. One book you'd recommend reading. Todd, you first.
Oh my God, my favorite book. Well, books, the trilogy by Hilary Mantel, Wolf Hall, Bringing Up the Bodies and The Mirror and the Light. Fantastic. I read them almost every year.
Nino?
We're going to Chicago for one of the stops of our benchmark tour, and every time I go to Chicago, I try to reread Devil in a White City, which is an awesome book by Eric Larson that talks about a murder and the World's Fair in Chicago. So a pretty cool book for anyone who hasn't read it.
Most exciting part of your job? Nino, you first.
I get to talk to everyone in private credit. It's super exciting. It's a market that has grown significantly over the past few years, and it is very exciting talking about what we're seeing in the market. So I'm never bored. Never bored.
And Todd?
Same answer. I get to talk to some of the most sophisticated investors in an asset class that I love and believe in. I'm blessed.
And then final question, Todd, you first. One prediction for the next 12 months.
Any prediction?
Any prediction?
The Eagles will not win the Super Bowl.
I hope not. Nino, what about you?
I've been playing with AI a lot lately, and I feel like everyone's talking about how AI is going to take jobs away and make things more difficult. I think it's going to bring more opportunities to the market. I feel like with AI now, ideas that you've had where typically you may have said, oh, this is going to be really difficult, become a little less difficult. And so I see AI being a booster of productivity and people, and there's going to be a lot more to do. So that's my prediction.
It's a perfect way to end it. Todd, Nino, thank you very much for your time. Really appreciate it. Continued success with the benchmark, and obviously continued success with both of your firms.
Thank you.
Thanks, Todd.
Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by DealCatalyst, the leading capital markets events and market intelligence company. For more information on DealCatalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.